Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, July 5th, 2021. I'm pre-recording this Trading Places Live for Tuesday, July 6th. Futures currently are pointing to a mixed open with a bit of relative strength in the Dow Jones, while we have NASDAQ futures lagging a bit. As far as today's agenda goes, we'll get into the daily market recap. Talking technically, I'm going to take a look at some of the sentiment indicators that I like to look at. Then I'm going to give you a sneak preview later Tuesday at 4:30 Eastern. I'm going to be hosting a free event, Second Half Market Outlook. I'll give you some instructions on how you can join me for that. It is completely free, but it does require being part of our Earnings Beats community. But again, I'll tell you in just a couple minutes. It's very simple if you'd like to attend, how to do that. Then we'll get into the earnings spotlight. We've got second quarter earnings getting ready to kick off here shortly. This week, the earnings slate's a little bit light, but things will definitely be picking up the following week with all the big banks reporting. And then we'll wrap up the show today with the three you must see, three stocks that have broken out recently, I think look really strong. So you'll definitely want to check those out. Before we get into any of that, let me take you over to earningsbeats.com. For those of you who are new to Earnings Beats, just want to point out we do have a free Earnings Beats Digest newsletter. It is published Mondays, Wednesdays, and Fridays typically, although I believe we'll probably have one out here this morning, Tuesday, since Monday was a holiday. But normally it's Monday, Wednesday, and Friday. Simply type in your name, email address here, and hit that subscribe button, and we'll make sure you get set up. It's completely free, no credit card required. You can unsubscribe at any time. And one other benefit of being part of this community is that when we have the free events, we send out room instructions, not just to our members at Earnings Beats, but also to our free Earnings Beats Digest subscribers. So that's another benefit, another reason to join our Earnings Beats community. So make sure you do that. Here at the top, you can see just a little bit of information about this 2021 second half market outlook that will begin Tuesday at 4:30 p.m. Eastern. I'm really looking forward to it. I love getting in, taking a look at what's going on underneath the surface of the market. It's really easy just to follow the S&P 500 to say, okay, we're going up or we're going down. But I've got some really interesting information to share with those of you who attend. There are some signs that in the right circumstances provide us really excellent warnings about the market, perhaps topping. Sometimes it's just short-term tops. Sometimes they're long-term warnings. And you've got to be willing to recognize those warnings and be open to the possibility of those warnings when they do appear. But I'm going to talk a lot more about that on Tuesday at 4:30 when that second half market outlook webinar begins. All right, let's move on to the action from Friday. Of course, Monday was a holiday. So looking back at Friday's action, you can see the Dow Jones Industrial Average up 152 points. Getting back close to that 35,000 level after that dip. Looked like we were breaking down, went below the lows in May, took out the major moving averages, but we came right back, got back above both of them, and now we're ready to break out again. S&P 500 already has broken out. It was up another 32 points on Friday, 43.52. Now, I know back at the beginning of the year, I don't know exactly where we were on the S&P. I think we were 3750, somewhere around 3700, 3800. And I actually made the prediction. I thought the S&P was going to 4,700, and folks probably thought, a lot of folks wrote to me and thought I was nuts because the market had gained back so much in 2020 after the pandemic. They're like, no way, we're not going any higher. I'm sticking to my guns. We're in a secular bull market advance. You don't mess around with them. If you miss them, they don't come back. And, you know, these secular bull market advances tend to last a couple of decades. And so when you think back to how far we've come, the secular bull market doesn't begin until you take out the prior highs. So when we took out the 2000, 2007 high, on the S&P 500. That was in 2013. 2 decades from 2013 takes you to 2033. I don't know if we're going to 2033, but I think there's a good chance that we get most of the way there, if not all the way there, with this current uptrend in place. Now, it doesn't mean we're not going to have cyclical bear markets from time to time. We absolutely will. I don't know how many we'll have. Maybe we'll have 1, maybe we'll have 5 between now and 2033. But the important thing is to recognize that you're in a long-term secular bull market, so that when things happen like the pandemic or like the trade war, your big picture focus is on prices going higher. That's really important. But anyway, we're going to talk about all that later. S&P 500, though, now only 350 points away from my target for 2021, and I remain very bullish. But second half could be dicey a little bit. We'll talk more about that later today. Anyhow, the NASDAQ up 117 points. So on a relative basis, actually outperforming both the Dow and the S&P 500. It is now up over 14,600. When we broke above 14.2, and I talked about an ascending triangle on crude oil prices, getting through 67, we were going to measure to 77. We're almost there. The NASDAQ, when we broke through 14.2, that measured to 16,000. And here we are now at 14.6. We still got room to run. And that's just an initial measurement, by the way. It doesn't mean that you're not going to go any higher than that. But I believe we're going to make a run for 16,000 on the NASDAQ. And I think it could be sooner than a lot of people think. But again, we'll talk about that later today as well. Mid caps down 7, small caps down 14. So these two areas continue to struggle on a relative basis. Part of that problem, when you look down here to energy hasn't been able to break out. And there are a lot of energy companies in the mid cap, small cap index. So that's certainly put a little pressure on those two indices. Technology, though, from a sector perspective, is on fire. The month of June, very strong, got off to a strong July. This is when technology and consumer discretionary tend to shine, heading in toward earnings season. It's the 3 weeks or so leading up to the start of earnings season where technology and consumer discretionary tend to perform really well. And you can see we're already looking very strong in technology. Consumer discretionary, just here over the past week or two, really has started to strengthen again, just broke out to an all-time high on Friday. Healthcare doing very well. The month of July belongs to biotechs. Biotechs love July and getting off to a really good start, healthcare in general, but biotechs more specifically. Communication services, all-time high. I mean, 3 of these 4 groups right here breaking out to all-time highs as we start July. These are aggressive sectors. It's very, very bullish to have our aggressive sectors breaking out right now. Anyway, energy was the laggard. It was down about 0.25% on Friday, just a little bit less than that. You can see we've been struggling really since we got up to 56. I think this 56, 57 area, there's a lot of long-term congestion on the chart for the XLE around $56, $57. And we're almost to the measurement on crude oil. So I would be a little careful with energy. I'm not sure we go a whole lot higher than where we are right now. I think money could rotate back out of that into these aggressive areas as earnings continue to approach. All right, moving on, 10-year Treasury yield. On Friday, we closed at the lowest level since back at the beginning of March, finished at 1.431%. That is putting a little pressure on financials on a relative basis and on industrials on a relative basis. The good news, because when the yield goes down, that tells us money is moving more defensively into treasuries. So that can be a bad sign for the stock market. And so we see money coming out of financials and industrials. These are 2 of the 5 aggressive groups. That's why it's so important what we're seeing right now in technology, communication services, and in consumer discretionary, because those are the 3 other aggressive groups. What we wouldn't want to see is all of these aggressive groups going down on a relative basis and money rotating into defense, which would be consumer staples, which would be utilities, real estate, in addition to healthcare. Healthcare has been doing pretty well of late. But for the most part, it's these aggressive groups that continue to lead. Now, energy and materials to me are just a different ball game. I don't really look at those two sectors for any kind of clues about the market. They tend to trade on their own. They tend to trade somewhat dependent on the dollar. Materials maybe more so than energy. And so, you really have to be checking out the dollar in terms of energy and materials. But here's the deal. When energy and materials are doing well and more money is rotating into those two groups, that's less money that can go into the aggressive groups. And that's one of the reasons why technology and consumer discretionary they were not performing well for a while, because more and more money was rotating to energy and materials. So it wasn't defensive stocks taking money away from those two aggressive areas. It was materials and energy. And now as the dollar is trying to rebound, we're seeing materials and energy on a relative basis rolling back over, especially materials. And that in turn is helping technology and consumer discretionary and communication services. So anyway, we need to watch the 10-year Treasury yield, but it's not just the yield. It's also how everything else is reacting. It's all the, it's the intermarket relationships that really are so important to follow. And that is going to be a big part of my discussion later when I get talk about the second half market outlook. All right, moving on to talking technically, I did want to point out a couple of sentiment indicators. You can see the volatility index, which shot up in March of 2020 with the pandemic, and we are just slowly working our way all the way back down. And this is what typically happens when we're coming out of a very fearful period, where we just, there was so much fear. The bulls just threw the baby out with the bathwater, basically sold everything. Didn't matter what was going on. We're just selling. Can't take the pain anymore. That's what happens when a major bottom goes in. And that's what happens, if you're looking, well, how can I tell? How can I tell when the baby goes out with the bathwater? Well, first of all, in a secular bull market, typically anything up in the mid 30s is baby out with the bathwater material. So February of 2018, beginning of February right here, you can see this drop. That was kind of baby out with the bathwater. Or how about the end of 2018 with the trade war? See that major bottom that went in right there? That's baby out with the bathwater kind of selling. Well, same thing during the pandemic. And this is normally associated with a major bear market low. Now, the pandemic was different. We were in a bull market, a secular bull market. I actually wrote about it on March 13th. Right in the midst of all this, I said we're in a secular bull market. A lot of folks wrote to me and thought I really had gone off my rocker. But the long-term picture, you just can't lose sight of the big picture. And that continues to paint a very, very bullish background for U.S. equities right now. But anyhow, anytime you start talking about VIX readings in the 80s, we've only seen this twice since we've had VIX readings. Once in the financial meltdown back in 2008, and then with the pandemic. These are the only two times we have seen the VIX close above 50 for these two events. So that's definitely baby out with the bathwater. That's just, I can't take the pain anymore. I've just got to sell. That's what those readings mean. So it is important to watch the VIX. But typically the VIX downtrends, and typically the VIX moves back down during bull markets to the 10 area. You can see that back in 2017, where we had very little volatility. We went down below 10, down in the 9s. I think we could see that in the second half of the year, certainly in 2022. So I think that's where we're heading. We're going to have these little spikes. Every time we get a little pullback, we're going to see a spike. But the spikes keep getting lower and lower, and I think we continue to drift down the VIX. The important part here to realize with the VIX sometimes, and it helps in the short term as a trader especially, to watch to see when the volatility rises when the S&P 500 goes up. The volatility always rises when the S&P goes down. If you look at the S&P 500, when we go down, the VIX is always going up every time. What gets interesting is when the VIX goes up when the market's going up, because that's telling us, okay, stocks are going higher, but nervousness is beginning to build in the market. Market's getting more fearful. And when the market gets fearful, it doesn't handle bad news well. As long as the VIX is low, we could have just about any bad news. Market might gap down a little bit at the open and it comes right back. But when you start seeing an elevated VIX, market starts getting more fearful while the prices are going higher, that can be a warning sign. And so I run this correlation, and anytime the correlation between the VIX and the S&P 500 is positive, that you should be raising your eyebrows a little bit. That should get your attention. And I marked on here, over the last 5 years, we've only had 4 instances where the correlation has turned positive to the extent of 0.5. And these 4 tops right here, if you look, this was a pretty significant top back at the beginning of March 2017. I mean, we didn't go down a lot, probably only about 3 or maybe 3%, something like that. But we topped and we didn't really go to a new high for another couple months. Here, didn't really do a whole lot for us, maybe went sideways for a month or so. But you can see these last 2, big drop in the S&P 500 when we got up to this level of correlation, positive correlation, and the same thing in September of 2020. So that was a warning sign. Another warning sign, if you look at the equity only put call ratio, the higher it is, the more puts are being traded. The lower it is, the more calls are being traded. So it's just this measure in the options world of how bullish or bearish options traders are. There are some really good options traders, but the overwhelming majority of options traders lose. Most options expire worthless. So those who are buying calls when the market's going up, you got to be really careful. You know, you get so excited and you think the market can't ever go down. Well, when the market's going up, a lot of times the options on certain securities can get very expensive and you're chasing. And the next thing you know, that stock hits a high and pulls back for the next several weeks. And all the options that were being bought are all taken out back behind the woodshed. And you know what's happening to them. So you just want to be careful. You don't want to be chasing stocks. And so by following this CPCE, the dollar CPCE, which is the equity only put call ratio, it just tells us when the market is getting overly fearful. So whenever this ratio moves up to extreme levels, it's telling us that a lot of folks are very nervous about the market. They're buying a lot of puts. And when readings get down way toward the bottom, it means that the market's getting very bullish, options world, very bullish. And so a lot more calls are being bought. Here's what I'll say about sentiment indicators, as in my experience. The extreme levels of fear are much more predictable than the extreme levels of complacency. Fear makes people do things that, just based on emotion. And so when you see this, everybody playing puts, it's like, okay, people don't think the stock market will ever go up again. And that is when markets form bottoms. And so if you look at these green arrows where these tops are, this is a 5-day moving average of the equity only put call ratio. The 4 highest readings over the last 5 years, look at where they came in at. Market bottom, just about at a key bottom before we had a big run. Major bottom, major bottom. I mean, it's not rocket science. When everybody starts buying puts and you see this ratio getting up, to that 0.80 level or above, look for a bottom. I mean, we're starting to get close. Now you can see here, we probably ran another week or maybe even a little over a week from the time we hit 0.80 till the time we hit 105. That is the highest reading we ever saw, though. I think in 2008, I think we got to 1.01, 5-day reading. Here was 1.05 with the pandemic. Trade war, 2018, we got as high just over 0.90. But you can see over 5 years, it's hard to get over 0.80 for a 5-day reading. So anything up in this level, you want to start thinking market bottom. Right now, it's down pretty low. But look at all of these moves down into the 0.4 range. And look at the market just keep going higher. I mean, yeah, we had pullbacks in here and some of them may have aligned with these lows. But if you're saying, hey, it's a bear market because of this, you're probably going to be wrong. Don't look for major tops when you see the market complacent. But when I see the market very fearful, I do look for major bottoms. That's the difference between the extremes. Anyhow, these two readings, the CPCE, when we were down here, it was in September, we got down to about 0.40, which at that point was we were going down here, this double bottom basically, but it was one of the most complacent readings. So everybody was buying calls in September. And if you go back and you look at the VIX that I had pointed out in September, right here, that was the highest reading in the last 5 years, the highest positive correlation. The stock market was going up, and so was the VIX. Market was getting fearful. And so that's what led me to write. Some people say, well, you're always bullish. You're just a perma bull. I'm not a perma bull. The stock market goes up a lot more than it goes down. So of course I'm going to be more on the long side. I think that's the better way to approach the market than to think we're at a top every day. And that's the way a lot of folks approach the market. They're always calling a top. And then, after we have major tops, they go back and they congratulate themselves and say, well, I called the last 3 tops. That's because you're always calling a top. Of course, you're going to call the top. But if I see warning signs, I'll write about them. I'll become very cautious in the near term, but that doesn't change my long-term view. There's a lot of technicians I've seen that get very wishy-washy. They're very bullish for a while and then see a couple of bad things happen, and then they're very bearish. All of a sudden, we're going into a bear market. That's not the way the stock market works. We have very, very long periods where the market goes higher. Those are secular bull markets, and long periods where we go lower, secular bear markets. We're in a secular bull market. So yeah, we're going to have periods like this. And this is where I talked about the positive correlation, and that's the other thing. Sometimes you can talk about things that happened months ago and say, yeah, you see how this worked out? If we look at it 2020 hindsight, it worked. Well, I wrote about this on September 3rd as we were topping. Positive correlation between the VIX and the S&P. You want to be careful. And then you've got put call ratio hits extreme level. And then throw some other factors in there. History favors selling in September. September is the worst month of the year historically. So you put all that together and it's just not worth the risk. Doesn't mean the market will go lower. I don't care how many warning signs are out there. The market could still keep going higher. But how much risk do you want to take? And that's what it comes down to. All right. Anyway, I'll be talking about sentiment a little bit later on Tuesday as well. Let's move on to sneak preview. So a couple of things I want to talk about in the webinar later today. Here you can see technology. Look at technology breaking out. Let me show you the XLY, consumer discretionary. Just broke out on Friday. These are all-time highs. The XLC, communication services, new all-time high. Healthcare, like I said, biotech's an aggressive part of healthcare, loves the month of July. Healthcare just breaking out to new highs. So it's hard to get bearish the market when you've got key areas of the market that are breaking out. And here we are in the period leading up to the start of earnings season. And I've wrote articles about this as well. I've written articles about this. So none of this should be new. But if we look on a relative rotation graph, RRG, this is the XLK, and here are the industry groups relative to the sector ETF. Look at renewable energy. That's a long tail. If you've ever listened to Julius de Kempenaar, who's the creator of the RRG charts, if you ever listen to him, he talks about the length of the tails, that they're very important because it really gives you an idea of the power behind the move. Well, I don't think there's any question at this point. We went from lagging to leading quadrant, and look at the strength of this move. And now renewable energy on a daily chart is further to the right than any of the 8 industry groups in technology. And that tells us that it has the best relative strength in the short term on a daily chart. But what's interesting is if we pull up a weekly chart, all of a sudden, look at renewable energy. It's way to the left of all these others. Why? Because renewable energy was getting crushed earlier this year. I mean, if we drag this back, you can kind of see back at the beginning of 2021, look where renewable energy was. The first 5 months of this year, I want you to follow. Look at renewable energy. I mean, that is just brutal. Now the momentum is picking back up. See that moving, turning higher? Look at that again. See, the momentum is picking up. It hasn't started on a weekly basis, long-term basis, hasn't started working its way back toward that this vertical line, which is the relative strength line. So we're still way over here to the left side. But the daily chart, again, if you go back to the daily, that's where we're seeing a lot of strength, relative strength. So it just hasn't factored into that weekly chart just yet. Anyway, again, I'll be talking about some more of this. As far as earnings go, upcoming Motorola, or no, I wanted to give you this is one of the stocks in the, no, I'm sorry, that was my fault. Skipped ahead here. But MSI was one of the stocks that actually starting to show relative strength in technology. And again, I'll get into more of that later. As far as the earnings spotlight goes, here's MSM, which is MSC Industrial. When you look at the relative strength, and this is what I try to pay a lot of attention to going into earnings, because I think it gives us good information as to what Wall Street is expecting out of a company. So MSM hit its relative high back in March. And so over the last 3 or 4 months, it's been slowly working its way back down. I'm okay with the chart, but we're trending below the moving averages right now. I would rather have something that's showing a little bit more relative strength. So MSM is one that I probably would pass on. One other stock that will be reporting in, by the way, MSM is reporting Wednesday. Levi Strauss reports on Thursday, LEVI. And this is one that was a really strong performer relative to clothing and accessories up until the beginning of May. And then you can see we pulled back, but now we're trending back up above the 20, and the relative strength has started to turn back up again. This one, I think we could see a beat on Thursday. I'm going to be very interested to see how Levi Strauss reports. Don't be surprised to see a gap up on this one. All right, last thing, the 3 you must see. Go through these kind of quickly. First up, I will give you Accenture. Accenture gapped up recently with heavy volume, clearing that prior high. Pulled back, didn't quite fill its gap, and now has turned back and moving higher again, breaking out. This is a leader. If I pull up the relative strength on ACN, you'll see that not only is it breaking out there, but it is also starting to turn up relative to software, which software has been very strong over the last several weeks. So strengthening stock within a strong group. Next up, EW. This is, excuse me, Edwards Life Sciences. Just broke out again on Friday. I like the stock. Wouldn't be surprised to see a pullback and a test of the 20-day at some point, which is where I would be a buyer. But I do like Edwards Life Sciences. Then we're going to wrap up with SPGI, which is in the specialty finance area. Broke out, put in a nice little cup, little handle down to the 20-day, and then the breakout. Nice volume on the breakout. I see this one measuring up close to 430, 435, currently at 414, so a lot of room to go. Anyhow, appreciate everybody tuning in. I'll be back on Wednesday morning over at Earnings Beats for your next Trading Places Live. And please remember to go over to Earnings Beats today and check out the website, become a Earnings Beats Digest subscriber so that you can come to the event on Tuesday evening. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.